Well, the last 7 days were one of the most brutal in my life. And I'm not talking about the markets. I'm talking about being down with COVID and being isolated alone for the last 7 days. But you know what? I'm alive. I made it. I'm out. And for the first time, I'm happy. I'm negative about something. But back to the market. So yeah, I can understand a lot of people are feeling really bad about the markets. It keeps going down every single day. S&P's down 18% year to date. Nasdaq down 29% year to date. And a lot of my students and people on YouTube are kind of like donkey on Shrek. Are we there yet? Are we there yet? Are we there yet? Are we there yet? I'm not sure, okay, but we're getting there, okay? Well, the good news is if you take a look at the triple Q Nasdaq ETF on the weekly candles, you can see that we are approaching this green line, which is the 150 moving average that was very strong support during the last two major crashes, 2018 and 2020. We're approaching that level. We're just shy of that level. And at the same time, you can see the fear and greed index, we are at extreme fear. So the market tends to bottom at the point of extreme pessimism, extreme fear, and the market tends to reverse. So we could be seeing a potential bottom very, very soon. Now, some of you are probably thinking, that's what you said last month. Or that's what you said 2 months ago, right? Hey, no one said it was easy to pick a bottom, right? No one has a crystal ball. All we can do as investors is to look at potential bottoms where it looks like it could be a bottom, but there's no 100% in life. And that's why when you invest, you never go all in at one point. You always average in stages as an investor. And if you're trading, you're swing trading, you see a potential bottom in a stock, you enter, but you put a stop loss as a trader. Once it hits the stop loss, get out, wait for the next potential bottom, get in again with a new stop loss. So again, it's a different concept, right? As a trader, you have a stop loss, hits it, get out, wait for the next entry signal. But as an investor, you're buying great companies that will rebound eventually. You don't need a stop loss, it will go up eventually. But again, you're always guessing where the bottom is. Now, eventually, it will bottom. Eventually, the correction will end. And that's why I always say as an investor, you always average in stages because you never know when the actual bottom will be. It's kind of like finding the perfect wife or husband, right? I mean, you meet someone and you think, okay, this could be it. This could be the one because it meets all the criteria, all the probabilities, but you never know, right? Anytime before the wedding day or right at the wedding day, it may fall apart and, it's okay. You move on and find the next one. Eventually, you will find the one, all right? Now, if you are feeling very negative or very lousy right now, I don't blame you. It's easy to get negative during these kind of corrections or bear markets. But I'd like to just share something with you. When I look back at my life, one reason why I feel I've been really successful, not just in investing over the many, many years, but successful in businesses, in relationships and all that is because I think one of the most important qualities that I have, that I think a lot of successful people have, it's not about how smart you are. I always say that there are a lot of people in school who were a lot smarter than me. There are a lot of people in school who are a lot hardworking than me, who are more hardworking than me, right? A lot of people in school had more talent than me. But over the years, I've achieved a lot more in my life and built a lot more wealth because one thing I have different from a lot of people is I tend to have more of an empowering mindset, a lot more optimistic. And I think that having the right optimism, seeing things in a certain way is one of the most important skills. So I'd like to share with you really about how you can see this in a different way. One of the beliefs I have is that there's no meaning in life except the meaning you choose to give to it. So some people when the market goes down, they say, you know what? I'm losing money. Why is this happening to me? Why is life so unfair? I'm losing everything. But some people when the market goes down, they say, you know what? I'm holding good companies. They'll go up eventually. Now it's a temporary opportunity if I have some more cash to add on more shares. So it's really what you say to yourself. And I'm the kind of guy who likes to see things, the cup half full instead of half empty. That I believe that behind every adversity is an equivalent or greater benefit. There's always a silver lining to everything in life. And I find that people who really make it in business or in relationships or investing, it's not that they're smarter. It's not that they are more talented, but it's because they see the world differently. They stay optimistic, they stay positive, and they take the right actions. Now, you may be thinking, what's so great about this year's market? We are we have one of the worst starts in the last 60 years. Well, I think it's a good thing, because I'd rather the market starts bearish and then we have the rest of the year to catch up or to make it back, rather than we start the year bullish, and then the last few months we turn bearish and we have no chance to turn it around for the rest of the year. So I think it's a good thing that we're starting out extremely bearish for the first 3 or 4 months, and then we have the last half or the last quarter to eventually be able to make everything back, or at least half back, to minimize the drawdowns for this year. In fact, if you take a look at history, there were many years in a market where the first 3 months or even 6 months were bearish all the way, but the market managed to make it all back, or at least half back, by the end of the year. And that's why I keep saying that it ain't over till the Fed lady sings. You never know what's going to happen. The interesting thing is that if you look at the decennial stock market pattern, which was researched by Larry Williams, basically he looks at all the past market patterns, right? And what he found interestingly was that all the years that ended with 2 had a very similar pattern. It's a really weird thing, and I've showed this before, right? That all the years ending with 2, and this year is the year ending with 2, they all tended to start the year very bearish. And they all started to come back by the second half or the last quarter. Now again, is this going to happen this time? No one knows. But the point is that it is possible, right? It is possible. And the other good thing is this. Now remember that this year is the US midterm election year. And I've mentioned this before. Again, what happens during the midterm election year? This tends to happen. If you take a look at all the midterm election years, the S&P 500 has averaged an intra-year pullback of minus 17%, which means if you look at all the midterm election years, on average, the S&P has dropped 17% on average, right? Now, some years more, like this year, you can see 1962, it dropped more than 20% this year, right? More than 20% over here. This one was also about, in fact, more than 20%, more than 20%, more than 20%, right? So a lot of them were more than 20%. Some of them less than 20%, but if you average, it was about 17%. So in other words, this year is not that all unique. It happened in all these midterm election years. And what happened during all these midterm election years? The last 3 months of those years and the first 2 quarters of the next year, which is 2024, tends to be highly bullish. Remember, the market is kind of like a rubber band. It's what we call a mean reversion machine. If you pull it too far down, it will snap back. But same thing, if you pull it too far, it's going to snap back as well. So right now the market is going down. Eventually it will reach a point where the rubber band will just snap back up. Now again, exactly where that is, no one knows. We can just only guess, right? But it has happened every single time. And my guess is it's going to happen by the middle of the year or latest by the last 3 months. Again, there's no guarantees, but based on history, it's pretty possible. Now, remember that the main thing that's causing the market to go down is this sky-high inflation. Inflation is not coming down. And yesterday, the inflation CPI came out was 8.3% higher than expected of 8.1%, but at least lower than 8.5% last quarter, but still very, very high, right? So the moment inflation looks like it's not coming down yet, the market's freaking out. Why? Because with high inflation, the market's thinking the Fed has no choice but to keep raising interest rates and tightening the monetary system and causing a recession. So that's the main thing. The moment inflation can peak and come down, the market will come roaring back, all right? And remember that during the last 12 times the Fed raised interest rates, in 11 out of those 12 times, the stock market actually had a positive return during all these periods. And some periods the market was up 13.7% a year, 24.5% a year, 7% a year. Now, if you take an average, you can see the average is 9% return a year during the times when the Fed raised interest rates. Now, 11 of 12 times, that's a 91% probability. So high chance that is going to happen again. Now, some of you are thinking, but Adam, there is still a 9% chance There's a 1 in 12 chance that is going to be negative. And that happened in 1972 and 1974. Adam, what if that happens? True, it could happen, and I call that the doomsday scenario. See, I believe that as an optimist, it's not just thinking about what can go right. As an optimist, you must think about the best case scenario, but you must always plan for the worst case scenario. So in this part of the video, I want to go back to the 70s. Let's go back to the 70s and let's study during this period when this didn't work, when it was a doomsday scenario. And what happened then was that same thing, inflation was out of control at the time, and the Fed Chair, Paul Volcker, had no choice. He said the only way to bring down inflation is I have to crash the economy. I have no choice. So he jacked up interest rates to freaking 12%. 12% interest rates, right? And that caused a major recession, major crash, and that eventually brought down inflation. And that was 1972 to 1974. Now, could this happen again? Unlikely, but it could. All right, so let's take a look. What if this happens? What happens in this doomsday scenario? And can we still make a lot of money from the markets in this scenario? Okay, so what happened in the 70s? By the way, I was born in the 70s. I was a 70s kid, born in 1974. So, but I was too young to remember this shit. Okay, so in the 70s, this is what happened, right? Inflation went up to freaking 12%, right? And then up to 15% inflation rate. So, again, at the time, the Fed Chair, Paul Volcker, he said, fuck it, right? I have to bring down inflation. I've got no choice. I have to crash the economy. So he jacked up interest rates. Now, right now, our Fed Chair, Jerome Powell, has only increased interest rates to 0.75%. And people are losing their shit. Oh my God, 0.75%, we're gonna die, oh my God. It's only 0.75%. Right? But this guy, Paul Volcker, he raised interest rates to 11%, to 12%, and then to 18%. I mean, that was mad, right? So what do you think happened to the stock market when that happened, right? I don't think Jerome's gonna do this, right? But when Paul did this, this is what happened. Let's check out what happened to the markets. Okay, so this is what happened, right? So over here, you can see the S&P 500, and the high at the time was 1973. That was the high in the markets. And the Fed funds rate is basically the rate set by the Federal Reserve, the Fed interest rate. So again, the Fed rate was initially at 4%. So he raised the interest rate from 4% to 11%, mad, right? And then raised it to 12%. So in response, the S&P market collapsed, right? It went into a recession bear market. It dropped 50%, right? It dropped 50% all the way down. And people are now thinking, could this happen? That's why they're freaking out, because they are remembering, ooh, the Volcker scenario, right? Now, how long did the market take to drop 50% at the time? It took 1.7 years to reach the bottom. All right. And once the bottom was reached, the market then went up 77% up to this level, took 1.9 years to get up there, then dropped another 20% over 1.9 years, and then finally took 2.75 years to go up 64% to the next peak in 1981. Now, what worries some people is that they say, but Adam, if I entered the market here in 1973, it would have taken me 7 years to break even, 7 years to get back to what I lost. That's true if you put everything in, if you invested at the freaking top, right? So unless you're bloody unlucky, that's unlikely to happen. And that's why I keep telling people that as an investor, you never go all in at one time. You must always do dollar cost averaging, like a regular savings plan where you invest every quarter or every month, slowly putting a bit into the markets, right? And one of the things that I tell people is the simplest thing is this, right? You should only go in when the price is at least down 10% from the high before adding your first tranche of investment. So for example, let's say from the top of the market, it drops 10%, you buy a bit. Drops another 10%, you buy a bit more. Another 10%, you buy a bit more. You average in every 10% drop right now. Of course, doesn't mean you get in right at the bottom because no one knows the bottom is. But if you do this kind of regular averaging in, then you'll probably average at this level, right? On average, we call it dollar cost averaging. You get in at an average price of say 90 points here, this purple line that you can see here. Now, so in other words, if you consistently go into the markets, right, adding to your investments, right, and this is your average cost, guess what? Do you need 7 years to break even? No. You can see that from the bottom, it just took 7 months for you to so-called break even. And after that, when the market goes up, everything else is gravy. Everything else is profit again. So the key is to, number one, stay in the market, and number two, to regularly save, right? Spend less than you earn, save, and keep adding to either the index ETF or shares of good businesses. But please don't, add more or buy stocks that are of lousy companies, right? Or of unproductive assets. This only applies to the index or of good companies. Now, not only will you so-called break even in just 7 months after the bottom, right? Which is okay, 7 months, right? But you can see that at an average price of 90 points, by 1980, which is somewhere here, all right, if you take this as the average cost, you'll be up 33%. And that's about 4% a year on average return. I mean, not fantastic, but at least you're making money, right? And by 1981, which is 1 year after that, right at this top over here, your total return would be 57.5% from your average cost. And that gives you an annual return of 6.7% during this period. But what if you take a longer term horizon? And that's why I keep saying that, in the long term, you always make a lot of money as an investor. But if you do it consistently, if you're disciplined to stay the course. Let's check it out in the next slide. So you can see that this was that doomsday scenario that we talked about. Market crash 50% or really terrible recession, right? So it looked terrible at that time. But again, when you take a look at it from a longer term perspective, it is just a small blip on the screen. Because following that, the market then went on a 26-year bull run and gained 2,213%. Now, even if you did not add more shares on the way down, even if you just went all in at the top, guess what? If you just stayed the course and you stayed in the markets, you can see that from 1973, given that you went in at the top, right, to 1998, the market gave an annual return, an annualized return of 9.52% a year, capital gain. Now, that's only capital gain. During that time, the average dividend yield on the S&P 500 was a 4% dividend yield at the time. So what's 4% plus 9.52%? That's a total return of 13.52% a year for 26 years. So always remember that in the long run, the stock market will always increase at a rate of about 10% to 12% a year on average, because that's the average growth of corporate profits, all right? Always has, always will for the last 100 years. But stock prices don't go up 10 to 12% every single year. It doesn't go up in a straight line. Stock prices tend to overshoot on the upside and overshoot on the downside in this way, right? So it goes up and go down and go up, and it does this, right? It does this. And what some people do is this. So if you invest regularly, every month, every quarter, so you are like buying regularly like that, buying regularly like that. And so sometimes you buy when it's overpriced. Sometimes you buy when it's underpriced. But if you keep doing this consistently, you find that on average, you would be buying at this line and you'd be getting 10 to 12% return a year, right? But what we do as value investors is we don't want to buy during these periods of time when the price is overpriced, right? We want to buy when the price is below that black line, when it's undervalued, right? So we want to buy over here, buy over here. So we want to buy over here. But again, by buying here, could it go lower? Yeah. Could it go lower? Yeah. So you never know the absolute bottom, right? But you don't have to buy at the absolute bottom. As long as you buy near the bottoms, like around this area here, okay, and you only buy very good businesses, you know how to pick good companies, and that's what we teach in the value momentum investing course, then you find that over the long run, you will be able to exceed this black line. Instead of getting 10 to 12%, you get 20% to 25% returns buying only the best companies in the world. Because within the S&P 500, within the 500 companies, you have got good companies, bad companies, ugly, beautiful companies. So you always want to focus only on the great companies with the strongest growth, the lowest debt, with the most predictable free cash flow. And again, you only add them when they're undervalued. Over the long run, you will far outperform the market. And that's the grand plan. And as long as you stick to this plan, you will do really, really well. So I hope that this has helped you. If it has, subscribe to more videos. And if you have not learned how to pick great companies and how to stick to your investment plan, how to manage your psychology, join our community. And we are there to help you reach your financial goals. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.